Welcome to the Simply Safe Dividends channel. I'm your host, Brian Bollinger. Thousands of dividend stocks exist, but only 53 of them earn the distinction of being a dividend king. That means they've raised their dividend each year for at least 50 straight years. So they've survived, periods of inflation, commodity booms and busts, rising interest rates, recessions, market crashes, the pandemic, and a bunch of changes in consumer taste and technology along the way. Any company that has navigated almost every environment imaginable while maintaining regular dividend increases is not only worth analyzing, but it could be something to consider if you're trying to build a growing and reliable passive income stream for retirement. I thought it'd be fun to put together a $1 million portfolio consisting of only dividend kings to see the strengths and weaknesses of this approach. So let's take a look. Our website, Simply Safe Dividends, makes it really easy to track your dividend portfolio. So I went ahead and plugged in all 53 dividend kings here. We have $1 million portfolio, and I equal weighted the portfolio. So you can see that every position is 1.9% of this portfolio to keep it nice and balanced, giving each dividend king equal representation by market value. Now, one thing that's unique about this group, you have some of these giant companies that you're probably familiar with, like Walmart, Procter & Gamble, Coke, AbbVie, Pepsi, Lowe's, Altria. But unlike the dividend aristocrats, which are required to be in the S&P 500, so they have to be a pretty big size, there's no size requirement for dividend kings. So you'll see that nearly half of the group consists of these small and mid-cap stocks that are under $10 billion in size from a market cap perspective. So even though these businesses have been around for over 50 years, generating cash, paying higher dividends, they've not really grown to become huge by public company standards, at least. The Dividend Kings group is really a representation of stability and consistency more so than kind of rapid, massive growth. So that's an important consideration to keep in mind as you think about potentially owning some of these Dividend Kings. You want to make sure your goals are kind of aligned with the goals of this group. Now, the portfolio's high-level stats here, the yield is about 2.6%. That works out to $26,000 of annual dividends. If we open up the income calendar here, we can see some of the payments that are coming in later this month. But the more interesting view is probably the year-ahead view here, where you can see how that annual income is spread out each month of the year. Most dividend kings are paying in December, March, June, and September. If we scroll down, we can see how this all comes together, one holding at a time. All the dividend kings, I think, are quarterly payers. Yes. So they blend together to give you this type of income stream if you were to own the entire group as your retirement portfolio. But you're probably a little disappointed that by a 2.6% yield, if you look at the individual stocks that are making that up, you'll notice that there's only 6 dividend kings that yield at least 4% today. There's going to be a lot that have much smaller yields, near 1% or even less in some cases here. So it's a little bit surprising. You'd think a company that's this old and has been paying a dividend that long would be a more mature business doling out a lot of its cash flow, but that's not really the case with dividend kings. A lot of these starting yields are probably not going to interest someone who's trying to build a retirement portfolio with more of a 3 to 5% initial yield to have a healthier amount of current income. But there's different reasons for that. If we go into the Diversification tab here, we'll get a better feel for the nature of this Dividend King portfolio, which looks very different from the S&P 500. You can see that there are 0 technology stocks, 0 energy stocks, and 0 communication stocks, which is not a huge surprise. Those sectors have different challenges. Energy is really cyclical. It's hard to sustain a payout with oil and gas prices moving so unpredictably. The tech sector is changing at a faster pace. A lot of companies there prioritize reinvestment in the business to grow faster and stay relevant. The sectors that dominate are consumer staples, industrials, and utilities, which account for about 70% of this portfolio's value. And it's not a big surprise. I mean, consumer staples, these are quite popular holdings in retirement portfolios. You've got Altria, so think cigarettes, tobacco with Universal, Hormel, Kimberly-Clark, Pepsi, Coke, a lot of well-known, beloved consumer brands that have been enjoyed by households and businesses for many, many years, have proven very hard to disrupt since they have such a lock on shelf space and big advertising budgets, and they're able to introduce new products to stay up with trends. But the consumer staples sector, not a huge surprise to see that in the lead. Industrials might come as a bit more of a surprise because this sector is usually thought to be pretty tied closely to the economy, which is cyclical. However, if you were to dig into some of the companies in this group, you would see that they sell a lot of products and parts and services too that have kind of a recurring element to their demand. It could be like cleaning supplies, drill bits, safety gear, replacement parts. A lot of these businesses have also developed really large installed base of their products over time. It could be like HVACs. So a lot of these mission critical products that they have out there need to be repaired and maintained over time, which gives them a healthy mix of replacement sales and higher margin aftermarket parts. And then utilities, also not a big surprise to see that as one of the three biggest sectors within the Dividend Kings group. These companies are basically government-sanctioned monopolies. They are the sole service provider in their territories, and their rates that they can charge customers are controlled by regulators to make sure they're fair, while also ensuring the utility earns enough profit to be able to invest enough to provide reliable service for the customers and businesses in its area. So those are usually very well known as dividend growth stocks that you can count on. From an income perspective, again, we kind of showcased that Altria and Universal have the highest yields in the group. These are focused in the tobacco space, but the group is pretty well spread out from an income perspective, which makes sense since we equal weighted the portfolio and a lot of the yields are kind of clustered around that 2 to 3% level. Now, a 2.5% yield isn't that bad, but if I'm investing in a portfolio or a stock that has a yield around 2 to 3%, I try and get kind of high single-digit dividend growth, which this portfolio is not quite delivering. You can see this chart here is showing you, based on the holdings today of all these Dividend Kings and the dividends they've paid out historically, how fast has that income stream grown over time? And the answer for the Dividend Kings has been about 5%. At least that's been true over the last decade, 5 years, and this year as well. You can see again how those values come together. Again, using the share counts in the portfolio and how much in dividends per share each stock is paying us. So a 5% growth rate, it's okay. It's better than inflation, but with a 2 to 3% yield, I would personally want to shoot for something a little bit higher than that, preferably closer to 7, 8%. You can still get some good growth out of this portfolio. This income forecast tool here is showing you the current portfolio's income of $26,000 and how it would grow over the next 5, 10, 15, 20 years based on the portfolio's 5-year dividend growth rate of 4.8%. And within 15 years, our portfolio's income would double at that type of growth rate. Again, that's assuming we don't invest another dime. We don't even reinvest the dividends. We're just taking them as cash and letting those companies do the work of growing their earnings and their dividends over time. If you were to reinvest the dividends, that increases the speed of compounding because instead of taking the dividends as cash and spending it, you're taking that money and buying more shares which pay more dividends. So in this case, you can see our portfolio's income would more than double in the next decade, going up to about $55,000. Of course, that's not accounting for inflation. If you were to ding a few percentage points of growth per year to do that, you'd look at something more like this 5% growth rate scenario, which is still not bad. But I think if you're, again, kind of closer to retirement, this group of Dividend Kings, while appealing for the track record of dividend growth, doesn't quite get the job done from my perspective with both current income and how that income is growing over time. Now, the good news is this income looks pretty safe. So one of the things that we spend a lot of time on each week at Simply Safe Dividends is dividend safety scores. This isn't some black box quant system. It's actual analysts doing the work, researching companies, looking at their earnings reports, transcripts, filings, presentations, what's changing in the economy. We do all this to assign how likely a company's dividend is to be cut over a full economic cycle, including the potential for a recession, which is hard to predict when it'll happen, but better safe than sorry. We try and keep a long-term perspective. Ratings go from 0 to 100. Above 60 falls in our safe and very safe buckets. What's unique about us is since we've been doing this in 2015 and beyond, we've kept a real-time track record of every dividend cut in our coverage universe, showing you this rating we had on the stock right before its cut was announced. So this gives you a good sense of how predictive these scores have been. And if you stuck with companies that maintained a score above 60, our safe and very safe buckets, you would have avoided at least about 830 of the 849 cuts that have occurred, so about 97%. So it's not perfect, but it can definitely be a helpful metric to look at when you're evaluating an investment, especially if you're thinking about retiring on dividends and want to prioritize the security of your income stream. Now, the Dividend Kings group today looks pretty solid. 90% earn a safe or very safe rating. However, that's not always been the case. There have been some fallen Dividend Kings. I put this together here, the short article kind of showing over the last 25 years, I counted 6 Dividend Kings that are no longer on this list because they each cut their dividend. VF Corp, which owns apparel and footwear like North Face and Vans, they're the most recent king to fall in 2023. They're dealing with a number of challenges, falling demand for some of their brands, too much debt after an acquisition. We also had a manufacturer of ATMs in 2016, kind of a similar story. Too much debt, big acquisition, trying to adapt its business. Here's a provider of home improvement building products, Masco. Had just recorded its 50th consecutive annual raise in 2008 to become a king, and then the housing market tanked, and they had to cut the dividend. We also have a couple of insurance-related companies here, and then a supermarket, Winn-Dixie, that basically had Walmart come in and take a lot of its share away, which resulted in a dividend freeze and then later a cut. So Dividend Kings aren't ironclad income investments necessarily, but the current mix of kings looks pretty good. The only two that we give a borderline safe rating to are Altria and Universal. There's some similarities with the reasons there. They're both involved in the tobacco space. I won't get into the whole story, but Altria looks like they may need to reinvest a lot more to be positioned for a world where combustible cigarettes aren't really as in demand as they have been over the last 50 years. A lot seems to be changing faster today than it has been even 5 or 10 years ago. So that's something to keep an eye on. There's not necessarily any near-term risk here. The borderline safe rating, we expect at least 2/3 of companies with these scores to maintain their dividends, but it's something to keep an eye on. You do get a higher yield to help compensate a little bit for those concerns. Now, the last couple things we'll look at with this portfolio, the Dividend King. So the yield is a little bit lower than you might like. The growth might be a little bit lower as well. But again, that idea of these are very consistent and stable companies is quite true. So I'm putting in a field here called Recession Return into the holdings table. I moved it over here so we can see it more easily. And we're looking at the financial crisis to compare how did these stocks do from 07 to 09 when the S&P 500 fell 55%. I believe that was from October to March in those years. And you'll see that most of these Dividend Kings were very resilient. I mean, they're still stocks. They're still going to lose value when there's panic. But Walmart actually gained 7% that year. We can see a handful of companies here, a couple of utilities, Abbott and healthcare, Hormel, packaged foods. They were down only about 10, 15, 20%. So less than half of the overall market's decline while continuing to pay a higher dividend during that otherwise stressful period, which is a big advantage of this strategy, especially in retirement. If you're kind of worried about what's a safe withdrawal rate, what happens if the market tanks 30% the year after I retire, dividends can take away a lot of that risk because you're locking in a yield today. And if you've done your homework to buy financially strong companies with long histories of raising their dividends, you can keep seeing your income coming in and increasing during those downturns without having to sell your shares, which provides great peace of mind and just a really nice income stream. The last thing I'll kind of spotlight here is this valuation column. So like any part of the market, there's going to be some stocks that are overvalued and undervalued. It can be usually quite difficult to tell which is which, but we've tried to make it a little bit easier for income investors by providing this newer valuation tool. So if I click on that, I'll be taken to the company's stock page, and this valuation chart will open up. Now, when you think about valuation, at least the way I think about it is stock prices follow earnings and dividends over time. There's a very clear connection if you pull up any company's chart for the most part and zoom out. In the near term, anything can happen. Stocks are volatile. They're driven by emotions and sentiment. But stock prices follow earnings and dividends over time. That's the first thing. The second thing is a lot of these companies we look at are quite mature businesses, especially Dividend Kings. They've been around 50 years. They're not really changing a whole lot. So I think they tend to trade at persistent valuation multiples. So in other words, the companies that we look at that are time-tested businesses, not much is changing. They pay a dividend. I think the market is going to typically value them at a fairly stable PE ratio and dividend yield over time around where they trade. So what we're doing here with this valuation tool, the stock price is shown in gray, and this expected price band in blue is saying, okay, if this stock's price traded within 10% above or below its 5-year average dividend yield, what would the stock be worth? And we can see over time with Stepan here in this example, that the stock price has followed that band. There have been periods where it's gotten above it and come back in, and we've been dealing with this. The last year and a half have been tough for the company because it's dealt with a number of both demand challenges and some operational issues that have caused its earnings to take a really big hit. We talked about this in the research note we posted this summer on the company. So yeah, softening demand, some operational disruptions are weighing on earnings. But when we looked at this, we thought, has anything really changed with Stepan's long-term outlook? We don't really think so. It's still a leader in a complex but essential sector, makes a bunch of specialty and intermediate chemicals that are used in everything from industrial cleaning products to personal care items. Just touches a lot of different niche markets, food, flavoring, pharmaceuticals. Has a broad reach with a lot of unique production processes and a big network of established customer relationships. So this valuation tool can be helpful to identify a stock that is out of favor but could be due to kind of revert back to the mean. So it can be an effective tool as you kind of look through this group of Dividend Kings to find some that might be more timely considerations with the yield they're offering and their future potential for good total returns plus that reliable dividend growth. But overall, I think if you're retiring and looking for safe dividends, which is, again, I think why a lot of people turn to aristocrats and kings, they feel comfort from those dividend streaks. I think you can kind of expand your scope a little bit because you can find stocks that have a better combination of yield and dividend growth than the Dividend Kings group as a whole does. In our screener here, I put in a couple of filters looking at companies that have grown their dividends for at least 20 straight years rather than 50, that earn safe and very safe dividend safety scores, that yield above 3%, and have most recently increased their dividend by at least 5%. And that gets us about 20 matches today. If you wanted to zoom in even more, you could add our valuation filter that I just kind of walked through to look at stocks that appear reasonably valued or undervalued. And this could be a decent place to kind of jump into and begin exploring for some of these quality dividend growth stocks. That could be a timely opportunity. You'll also find, besides that valuation tool, you can review a stock's financials. In this case, we're looking at Eversource Energy, a regulated utility. We can see its payout ratio is just extremely stable at about 60%. Earnings have marched up like clockwork over time. The company's margins are very stable. Its balance sheet leverage has gone up a little bit, but not too concerning. And then, of course, its dividend growth record over time, very consistent, kind of mid to upper single digit dividend growth over the last 20 years. So it makes it very easy to kind of go through a new idea. We might have research on it you can read as well. And of course, the dividend safety score and all these metrics summarized at the top. So there's plenty of places to hunt outside of Dividend Kings is the main point for ideas. The screener is one way to do that. We also offer a newsletter with model portfolios you can check out. There's just a lot on Simply Safe Dividends. If you wanted to try it, it's completely free to try for a couple of weeks, no credit card required or anything like that. So I hope this video was helpful. If you enjoyed it, it would really help me out if you considered liking the video and subscribing to our channel. I stay focused on sharing dividend stock analysis and investing tips, usually trying to post a couple of videos every month, 2 to 4, that type of range. Thanks again for watching, and I hope to catch you next time.